January 30th, 2026. I want you to remember that date. Write it down. Screenshot this moment. Because what happened in the last 24 hours hasn't happened in over 100 years. Silver didn't just drop. It didn't just correct. It didn't do what normal markets do when they're taking a breather. It absolutely cratered. From a record high of $121 an ounce to $76, that gone, vanished. Over 30% of its value evaporated in a single trading session. Let that sink in for a second. Now here's where it gets interesting. Every mainstream outlet right now is running the same headline. Silver bubble pops. Precious metals crash. The party's over. But they're missing something huge, something that anyone who actually knows their history should be paying very close attention to. Because this exact scenario, this exact pattern, has happened before. And what came next changed everything. The last time silver experienced a crash this violent was 1980, the Hunt brothers situation. But here's the thing that nobody's talking about. The mechanics of what just happened aren't anything like 1980. They're actually much closer to something that happened a century ago. I know. Bear with me here. Because in 1921, commodities experienced one of the most brutal crashes in American history. Prices fell 40% or more. The stock market lost nearly half its value. Unemployment spiked. Everyone thought the world was ending. And then something remarkable happened. The very same forces that caused that devastating crash created the conditions for one of the greatest wealth explosions in modern history. The Roaring Twenties didn't happen despite that crash. They happened because of it. Now, I'm not here to tell you everything's going to be fine. I'm not here to pump anything. What I am going to do is show you exactly what happened over the past 24 hours, why it happened, and what the historical record tells us about what usually comes next. Because here's what the talking heads won't tell you. This crash wasn't random. It wasn't just profit-taking. There was a specific catalyst, a specific mechanism. And understanding that mechanism is the difference between panicking like everyone else and seeing what's actually happening. So let's start with the trigger. Friday morning, the announcement comes through. Kevin Warsh has been nominated to replace Jerome Powell as the next chair of the Federal Reserve. Now, if you don't follow the financial world closely, that name might not mean anything to you, but to Wall Street, to the precious metals markets, that name sent shockwaves. Warsh isn't just any nominee. This is a guy who served as a Fed governor from 2006 to 2011. He was there during the 2008 financial crisis. He was Bernanke's right-hand man, the bridge between the Fed and Wall Street. But more importantly, he has a reputation, a specific reputation that markets know very well. He's known as a hawk. In Fed speak, a hawk is someone who prioritizes keeping inflation under control, someone who prefers tighter monetary policy, someone who isn't afraid to let interest rates stay higher for longer if that's what it takes to maintain a strong dollar. The moment that nomination was announced, something changed in the markets. The dollar surged. And when the dollar surges, precious metals typically do the opposite. But what happened next wasn't just a normal inverse reaction. It was an avalanche. You see, over the past year, silver had been on an absolute tear. We're talking gains of over 150%. It had gone parabolic. And when something goes parabolic, it attracts a certain type of money. Leveraged money, borrowed money, money that's betting big on the trend continuing. The moment the Warsh news hit, the moment the dollar started spiking, margin calls started going out. And when margin calls go out in a crowded trade, you don't get an orderly exit. You get a stampede for the door. Matt Maley, equity strategist at Miller Tabak, put it perfectly. He said, most of this is probably forced selling. This has been the hottest asset for day traders recently. There's been leverage built up. With a huge decline, the margin calls went out. Forced selling, margin calls, leverage unwinding. Those are the mechanics. Those are the gears that turn this from a normal correction into an historic crash. But here's the question nobody's asking. Is this the end, or is this the beginning of something else entirely? That's where 1921 comes in. To understand what just happened, you need to understand Kevin Warsh. This name, this single name, is why billions of dollars vanished from precious metals markets in hours. This isn't just some random bureaucrat being shuffled into a government position. This isn't another faceless appointee that markets can ignore. This is someone who Wall Street knows intimately, someone with a very specific track record. Someone whose very name, the moment it was announced, triggered one of the largest single-day precious metals crashes in modern history. Let me paint you a picture of who this man is and why his nomination mattered so much. Warsh started his career at Morgan Stanley, investment banking, mergers and acquisitions. He spent 7 years there, working the trenches of Wall Street deal-making. Then came the move to Washington, first as a special assistant for economic policy in the Bush administration. Then, at just 35 years old, he was appointed to the Federal Reserve Board of Governors, the youngest appointment in Fed history, When he took that seat in 2006, nobody could have predicted what was coming. Within 2 years, the entire global financial system was on the brink of collapse. During the 2008 crisis, Warsh became something unique. He was the liaison, the translator between the Federal Reserve and Wall Street's biggest players. According to David Wessel, who chronicled that period, Warsh established himself as Bernanke's protector in certain circles and as the chairman's bridge to Wall Street chief executives. He was there when they converted Morgan Stanley into a bank holding company overnight to save it from collapse. He was there when they were trying to engineer emergency mergers to prevent the system from imploding. But here's the thing that made Warsh different from the rest of the Fed at that time. He had reservations, deep reservations. As the Fed launched round after round of quantitative easing, pumping trillions into the system, Warsh became increasingly skeptical. He worried they were going too far. He worried about what he called misallocations of capital. He warned that the extraordinary measures weren't addressing the real problems. In one Fed meeting, he said something that still resonates today. He said, "We are removing much of the burden from those that could actually help reach these objectives. We are putting that onus strangely on ourselves rather than letting it rest where it should lie." In 2011, he walked away, resigned from the Fed years before his term was up. And since then, he's only become more vocal in his criticism of easy money policies. So when markets heard his name Friday morning, they knew exactly what it meant. This is someone who, at his core, believes in monetary discipline. Someone who believes that when things get too loose, when too much leverage builds up, a correction isn't just inevitable, it's necessary. Now here's where it gets really interesting. The dollar index jumped immediately. Why? Because a Warsh-led Fed signals a stronger dollar policy. It signals that the easy money era might actually be ending. It signals that the debasement trade that's been fueling gold and silver for years might be hitting a wall. And that's when the cascade started. See, when you have a parabolic rally in any asset, you have weak hands and strong hands. Weak hands are the traders using leverage, the ones who got in late, the ones riding the momentum with borrowed money. Strong hands are different. They're the long-term holders, the ones who accumulated at much lower prices, the ones who aren't fazed by short-term volatility. What happened Friday was a forced liquidation of weak hands. The margin calls went out. Positions had to be closed. And when everyone rushes for the exit at the same time, prices don't just fall, they collapse. One analyst described the precious metals market as turning into a slaughterhouse. Silver crashed from 115 to below 78 in a matter of hours. But here's what the panic sellers might be missing. When weak hands get flushed out, something else happens. The asset moves from nervous money to patient money, from leverage to real capital, from speculation to accumulation. And that's exactly what happened in 1921. After the massive crash that year, after the liquidation phase ran its course, what remained wasn't a broken market. It was a cleansed market, a market that had shed its excesses and was ready for something new. Because here's the uncomfortable truth that most people don't want to hear. Sometimes crashes don't mark the end of a bull market. Sometimes they mark the transition from one phase to another, from the speculative phase where everyone piles in to the accumulation phase where the smart money quietly builds positions. Is that what's happening now? We can't know for certain. But to understand the possibilities, we need to go back, way back, to a time that most people have completely forgotten. Most people have never heard of the Depression of 1920, 1921. You can earn an entire economics degree without ever encountering it. The textbooks skip right past it. The professors don't mention it. It's become the forgotten depression, the crash that history erased. It's been completely overshadowed by what came later. The Great Depression of 1929 dominates the history books, but what happened a decade earlier was in many ways more severe and far more instructive for what we're seeing today. Let me take you there. World War I had just ended. The global economy was trying to reconfigure itself. During the war years, there had been massive inflation. Prices had roughly doubled. The money supply had exploded as governments printed to finance the conflict. Then came the reckoning. The Federal Reserve, which had only been created in 1913, decided it needed to act. They raised interest rates aggressively. The discount rate went all the way up to 7%. Adjusted for the deflation that followed, some economists say it felt more like 15% in real terms. What happened next was brutal. Industrial production plunged by 30% in just over a year. The stock market lost nearly half its value. Commodity prices crashed by more than 40%. Unemployment spiked to somewhere between 8 and 12%, depending on whose estimates you trust. Sound familiar? It should, because what we saw Friday, that 33% drop in silver, that's exactly the kind of violent price action that characterized 1921. But here's what makes that period so fascinating and so relevant to today. The crash wasn't treated as a crisis to be fought with more easy money. There were no bailouts. There was no quantitative easing. The government actually cut spending. Federal expenditures dropped by 65% between 1919 and 1920. And then something remarkable happened. The Depression ended, not in years, in months. By mid-1921, the bottom was in. And what followed wasn't a slow, grinding recovery. It was an explosion of economic growth that nobody expected. From 1921 to 1922, industrial production jumped by nearly 26%. Residential construction surged by 58%. Manufacturing employment increased by almost 10%. The economy didn't just recover, it launched into one of the most prosperous decades in American history. The 1920s began to roar. Think about what that means. The same conditions that created devastating losses also created the foundation for incredible gains. The pain wasn't pointless, it was preparatory. Now, I'm not saying history repeats exactly, it doesn't, but it does rhyme, and the rhyme here is too strong to ignore. What happened in 1920-1921 was a liquidation phase. The excess leverage from the warriors was forced out of the system. Prices adjusted to reality. And once that painful process was complete, the economy wasn't weaker, it was stronger. The weak hands were gone, and what remained was a foundation for real, sustainable growth. James Grant, the financial historian who wrote an entire book about this forgotten depression, put it this way. Easy money had financed the boom. Now dear money began to smother it. That's exactly what we might be witnessing now. For years, we've had easy money, zero interest rates, quantitative easing, unprecedented money printing. And that environment created the conditions for speculation, for leverage, for the kind of parabolic moves we've seen in precious metals. Now, with Warsh's nomination, the market is pricing in something different, a potential return to monetary discipline, a stronger dollar, an end to the debasement narrative that's been driving the metals rally. But here's what the panic sellers might be forgetting. Silver didn't go to zero in 1921. Commodities didn't become worthless. They went through a violent adjustment, a reset. And for those who understood what was happening, that adjustment wasn't a disaster. It was an opportunity. The Bureau of Labor Statistics data shows that the deflation of 1920-1921 was actually more severe than anything seen during the Great Depression. Consumer prices dropped over 15% in 12 months, yet the recovery was swift and strong. Why? Because the liquidation was allowed to run its course. The excesses were purged, and what remained was a system that could actually support sustainable growth. Now look at what happened Friday. Silver stabilized at around $70 to $71 an ounce. That level coincides with the 50-day moving average and represents the previous peaks from late 2025. In other words, it didn't crash into oblivion. It crashed back to a level that makes technical sense. Analysts are already noting that if silver holds this level through the weekend, we could see a demand response rather than continued selling pressure. The forced liquidation may have run its course. The weak hands may already be gone. And that's when the real question becomes, who's buying at these levels? Let me break down exactly what happened on Friday, because understanding the mechanism is crucial to understanding what might come next. The crash wasn't a single event, it was a cascade, a series of dominoes falling, each one triggering the next. And once the first domino fell, there was no stopping what came after. Think of it like an avalanche. The snow builds up over time, layer upon layer. Everything looks stable, peaceful even, until one small trigger, one vibration, one shift in the wind, and suddenly everything comes crashing down. That's what we witnessed. The snow had been building for months, the leverage, the speculation, the crowded positioning, and Friday was the trigger. The first domino was the announcement itself. Kevin Warsh nominated as Fed chair. Markets immediately processed what that meant. Tighter policy ahead, stronger dollar, less accommodation. The dollar index started climbing. That was domino number 2. Now, when the dollar strengthens, it creates pressure on precious metals through multiple channels. Gold and silver don't generate yield. They don't pay dividends or interest. When the dollar gets stronger and rates potentially go higher, the opportunity cost of holding non-yielding assets increases. Why hold gold when you could hold treasury bonds paying solid interest in a strong dollar? But that's just the fundamental pressure. The mechanical pressure was far more severe. See, over the past year, silver had attracted massive speculative interest. We're talking leverage ratios that made veteran traders nervous, futures positions that were stretched to extremes, options activity that suggested everyone and their brother was betting on the rally continuing. When the fundamental narrative shifted on Friday morning, all of that leveraged money became vulnerable simultaneously. Here's how margin calls work. And if you're going to be in these markets, you need to understand this cold. You borrow money to buy an asset. You put up some collateral, usually a percentage of the total position. As long as the asset price stays above a certain level, you're fine. Everything works smoothly. You're making money on paper. But when the price drops, your broker requires more collateral. They send you what's called a margin call, and you have to respond quickly. If you can't provide additional funds, they don't wait. They don't ask politely. They don't care about your reasons. They liquidate your position. They sell immediately at whatever price they can get. Market orders, not limit orders. They just want out. When one leveraged position gets liquidated, it pushes the price lower. That triggers more margin calls, more liquidations, more price pressure. It becomes a self-reinforcing cycle that feeds on itself. Matt Bunchkovsky, an independent analyst, described it perfectly. He said the precious metals market turned into a slaughterhouse as silver crashed from above 121 to 76 in just 48 hours. But there's another element that amplified the crash. Month-end positioning. Friday, January 30th, wasn't just any Friday. It was the last trading day of January. Month-end is when many funds need to report their positions, when they need to close out certain trades, when liquidity can get especially thin. Thin liquidity means that selling pressure has an outsized impact on prices. $100 million of selling in normal conditions might move the price modestly. The same selling during month-end, when everyone's trying to square up positions, can move the price dramatically. Then there was the confusion factor. There were reports that some news items about rare earth metals and commodities were causing additional confusion in the market. Traders weren't sure what was real and what was noise. In that environment, the instinct is to reduce exposure first and ask questions later. All of these factors converged on Friday. The fundamental shift from the Warsh announcement, the mechanical cascade of margin calls, the thin month-end liquidity, the general uncertainty and confusion. The result was a crash that erased weeks of gains and hours. But here's the crucial point. This was forced selling. This wasn't fundamental investors deciding that silver is worthless. This was leveraged positions getting liquidated involuntarily. And forced selling, by definition, creates artificial price levels. Prices that don't necessarily reflect true supply and demand. Prices that often overshoot to the downside, just as they overshoot to the upside during parabolic rallies. Consider what happened afterward. Even on Friday afternoon, there were reports of 40 to 50% bounces from the lows. Traders were posting about demand coming in at the lower levels. Not panic selling, buying. Today, the market has stabilized. Prices are consolidating. The initial shock is being absorbed. One analyst noted that silver found support at its 50-day exponential moving average, around $71. This level coincides with historical peaks from late 2025. In technical terms, this is significant. It suggests that the crash found a floor at a level that makes sense, rather than plunging into complete chaos. The next major support level is around $55, which aligns with the 200-day moving average. That's the level bears would need to break through to confirm that something more serious is happening. For now, the question is whether Friday's liquidation was a one-time event or the beginning of a longer decline. And that brings us back to the historical parallel. Because in 1921, the liquidation phase was violent but brief. Once the forced selling exhausted itself, the recovery began almost immediately.